Happy morning, people. So, new day. We are starting with a new topic called IND AS 115, revenue from contracts with the customer. That's the name of the standard. Basically, revenue recognition standard. In your CA intermediate, you had accounting standard 9, talk about revenue recognition. And for construction contractor revenue recognition, you had accounting standard 7. Now, in IND AS CA final level, both these standards have been merged, and one standard gives a comprehensive revenue recognition treatment. Where for every contract, whether it's construction contract, normal service contract, if you are a dealer of goods, doesn't matter. Or for everybody, revenue recognition is as per IND AS 115 as the IND AS. Okay, na sir, that is one. Sir, is AS and IND AS similar? Sir, no sir. There is a lot of difference between AS 7 and IND AS 115 in terms of approach. Yeah, in terms of context, there are a lot of differences over here. This is also a big ticket topic. Usually we do expect some good amount of marks to turn up from this topic. But one advantage of this topic is, both for you as well as for the examiner, is we have a lot of small concept. One big question coming from IND AS 115 is pretty rare. Not that it can't come, but we don't have too many big questions here. Maybe you could say roughly around, 5 to 6 roughly some big questions are there which can potentially come straight away for an 8 marker or above. So we don't have too many like that, but we have small concepts, right? So what ICAI can do is they can combine multiple small concepts and make a 10 marker question. Like they can make 5 subparts of 2 mark each. Like this, you have a lot of sub concepts, or this small concept can be easily brought into case studies also, which is what usually ICAI likes to do. They take small concepts and make a case study out of it. They can build a lot of story. Revenue, no. They can say, we company did this, they went there, full Ramayana, Mahabharata, they can give. They can build on this. Okay, that way, yes. But if you read, question may look big, but it will be pretty straightforward. Small concept ka collation or combination is what they have done. They would have done. Okay, an important standard, as I told you. Next, right? The last, I think, last 10 or 15 days, we will take up a little straightforward, easy topics. Till then, we'll be covering all the big ticket topics. I believe in whatever is big, whatever is important, first cover of that. Not that the last 15 days topic are not important, but they can be finished within one day. So let's take up, even this also roughly will take, I think, at least 4 days. So this will take, regular batch may we take roughly 7 to 8 days for this. All right. I think here we'll try to kind of do it in 4. Let's try to do it in 4. Fine. All right. Now, how does IND AS 115 work? Now, as per IND AS 115 works, right? There are 5 steps for revenue recognition. How many steps? 5-step process is the revenue recognition. Okay. If 5 steps are satisfied, then only a company will book the revenue. Otherwise, no. Okay. So once I'll call it out, each step, you don't have to write this down or anything. Each step we'll have to discuss in detail. First, I'll just call out the step once for your reference. First is identifying the contract. First step, number 1. Second one, identifying the performance obligation. That I'll call it as PO going forward. Third one, determining the transaction price. I'll call that as TP going forward. Okay. Fourth one, allocating the transaction price to the performance obligation. 4th step. 5th one, recognize the revenue when performance obligation is satisfied. These are the 5 steps of revenue recognition. Each step will have to determine one by one. Okay. And this particular topic, I need a little bit of your help. See, revenue recognition will happen in which step? When the 5th step is satisfied. So now when I'm discussing the concepts, right, you don't worry about what is the journal entry for it or how much revenue should be recognized. Because if I'm discussing step number 1, and if you say what revenue should be recognized, I should directly dive to step number 5. But between step number 1 to step number 5, there are other steps which we have not learned. So for the time being, what I want you to do in this topic is, if we are in step number 1, I want you to focus only on that and not worry about how much revenue to be recognized. That's step number 5. We have a lot of questions. There we will take it up. Okay, now only that particular ambit you keep it. I know that when we are discussing one thing, right, your mind will automatically say what entry will come, how much revenue will recognize. That wala doubt, you will get it. It's valid. But the problem here is when step number 1 if you are asking step number 5 ka doubt, then I will also not be able to, I can tell, but you'll not understand because there are in between 3-4 steps. So let's, as much as possible, try to keep it at that level itself. And don't worry, once we come to step number 5, all your other doubts which you had will get sorted. If you have a doubt, you can probably note it down, right? And then once we come to step number 5, then again read that doubt. Most of them will be sorted. If it is still not sorted, you can always feel free to ask. Yes, sir, Sarji? Oh, okay, that is one. Okay, let's go for first step now. Step number 1 is what? Identifying the contract. Identifying the contract with the customer. Okay. Sir, contract means what? Again, this one, no people. Small things are there. Usually what happens is they will give you a 2-marker case study question. If it comes as an MCQ, we just need to identify the answer. If it comes as descriptive, then you need to know the provision. So I don't know how ICAI prefers to ask this. Most of the cases, it comes as a case study. In that case, as long as you get the right answer, it is good enough. But if it comes as descriptive, you need to know the provisions. So again, I will leave it to you how you want to take this. Okay, my suggestion is better know the provisions, right? That's what I would say. Okay, first step. First step means what? Identifying the contract. If you want to call something as a contract as per IND AS 115, basically contract is an agreement between 2 or more parties that creates enforceable rights and obligation. You look for something called enforceable rights and obligation. If this is there, then only it is a contract. One, that contract should be agreed by all the parties, and that contract should create what? Enforceable rights and obligation. Like here, just to take a small example. Let's say X Limited and Y Limited have made a contract where X will sell goods for 10 lakh. X will sell goods to Y Limited for 10 lakh. Can you tell me what is X Limited ka rights over here? What is X Limited ka right? Right, X Limited has a right to collect the 10 lakh money. That is X Limited ka right. What is X Limited ka obligation here? To deliver the goods. That is X Limited ka rights and obligation. Similarly, Y Limited ka rights and obligation, are you able to identify? Yeah, what is Y Limited ka right? To collect the goods. What is Y Limited ka obligation? To pay 10 lakh rupees. Yes or no? So this is what we mean by a contract. Each party ka rights and obligation you should be able to identify, and you should enforce it. Enforce it means, it should, meaning if X does not fulfill their obligation, then Y will have a right for compensation. That is what we mean by enforceable rights and obligation. So if there is an agreement between 2 or more parties with enforceable rights and obligation, then it will become what, sir? A contract as per IND AS 115. The key word there is enforceable rights and obligation. First is that. Okay. Now, for it to be a contract, IND AS 115 has given some condition. Okay. That is ARPCC. We'll remember it as what? ARPCC. What is A? Contract terms should be agreed or approved by all the parties. It's given over here. Okay, the contract terms should be agreed or approved by all the parties. Once I'll call it out, it's pretty much common sense. In fact, really, R is each party ka rights and obligation you should be able to identify. That is your R. P, payment terms should be identified. C, the contract should have a commercial substance. Another C, consideration collection should be probable. If all these 5 conditions are satisfied, then only we can call a particular agreement as a contract for IND AS 115. Okay, first one again. What is first one? A. Contract terms, whatever terms the contract has, it should be agreed and approved by all the parties in the contract. That is one. That's fine. All the parties should be okay with the terms mentioned. R for rights and obligation of all the parties you should be able to identify. P for payment terms you should be able to identify. Now people, X has sold the goods for 10 lakh. That means can Y Limited pay money whenever they want? No, there will be a time, right? 1 month, 2 months, 10 days, 40 days, like that. Right? So when X will receive the money or when Y should pay the money, that payment terms should be clearly mentioned. That is your P. Okay, when the payment one person has to pay the other, that should be called out or identified. Another C for contract to have a commercial substance. Commercial substance you already know. We have studied in IND AS 16. Commercial substance means due to this transaction, cash flow should change. There should be some change in the cash flow. Risk, timing, amount of cash flow should change because of this. Okay. Now here, X Limited purchased this goods for, let's say, 8 lakh. X Limited purchased this goods for, let's say, 8 lakh. How much are they selling it for? 10 lakh. So obviously cash flow changed. They're getting extra cash. How much? 2 lakh. Right. Now that is what we mean by transaction to have CS. CS as in commercial substance. That's your C. Last one is consideration collection should be probable. Now X has sold the goods, no? Right? X should have a reasonable assurance that we will collect the money. Let's say if the credit period is, let's say, 2 months. then X should we have a reasonable assurance that after 2 months they will be in a position to collect the money from Y. Now if X has sold goods to Sri Vijay Mallya, now do you think X will have an assurance that after 2 months they will collect the money? Doubtful. That is what last condition is trying to say. Consideration collection should be probable, meaning the seller should have a reasonable assurance that they will collect the money from the buyer. You don't have to wait till the time money is collected. We just need to have an assurance that we will collect it. That is your C. If all of them are satisfied, then a particular component or an agreement becomes contract for IND AS 115 purpose. Tell me once again. Contract is basically, since this has a lot of small concepts, I will frequently repeat it for you so that we'll try to learn it here only or try it. This is a pure memory game, right? So let's try to remember everything in the class. Are you okay with that approach? If you feel no, I will manage, then once I will say and I'll move forward. What do you think? Or frequent repetitions, are you comfortable with that? So that we try to kind of remember it in the class itself. I would like to do it that way. With your permission, can be. Okay. Now contract is basically what? An agreement which creates, it's an agreement between two or more parties which creates enforceable rights and obligations. And now for you to call an agreement as a contract, condition should be satisfied. That we are remembering it as ARPCC. What is A? Contract terms and conditions should be approved or agreed by all the parties. R for rights and obligation you should be able to identify. P for the payment terms, when the payment should be made, you should be able to identify. C for the contract should have a commercial substance, meaning due to this contract, cash flow should change. Another C for consideration collection to be probable, meaning the seller should have a reasonable assurance that they will collect the money from the buyer. First aspect over. Clear? Okay, next one, contract term. Contract term as in duration. So usually contract term is the agreement period. Let's say you made an agreement for 6 months. You made an agreement for 6 months, whatever. Then that 6 months only becomes what? That agreement period only becomes contract term. But in some cases, contract term can be lesser than agreement period also. Usually contract term is the period mentioned in the agreement. But sometimes it can be lesser also. How? Look at this example. Application of this next question. A gymnasium enters, basically a gym entity. They've entered into a contract with a new customer to provide access to gym for a 12 months period. A gym and a customer have made a contract that the gym will give gym access to customer for how many months? 12 months. So the agreement period is what? 12 months. For how much money? 4,500 rupees per month. The customer has to pay to the gym 4,500 and gym will give access to the customer for 12 months. Okay, this is 4,500 per month. The member can cancel his or her membership without penalty after 3 months. So though the contract is for how many months? Agreement says what is the period? 12 months, right? But after 3 months, if customer wants, they can cancel this contract. And is there any penalty here or no penalty? Now you tell me, for it to be a contract, you should have enforceable rights and obligations. Suppose 4th month, customer cancel the contract. 4th month, customer cancel the contract. And gym people take, oh no. Only 3 months you have taken the gym, 9 months you have cancelled. Pay 9 months ka 4,500 rupees to me. Can gym tell the customer? Since you cancelled the contract in 4th month, balance 9 month ka gym fees you pay me. Will it work like that? No. Because they clearly say, is there any penalty clause here? After 3 months, there is no penalty clause. That means rights and obligation you can enforce only for how many months here? First 3 months. Hence contract term will be, CT here will be 3 months. Because for it to be a contract, you should have enforceable rights and obligation. Here, rights and obligation you can enforce it only after 3 months. Okay. Now, if customer cancels the contract in 4th month, will they get the right to access the gym or gym will cut off their membership? Gym will say, sorry, access denied. So, rights and obligation, you can take it up only till 3 months. Hence, contract term will be 3 months. That's what this said. Contract term is usually agreement period, but sometimes it can also be a lesser period. Here, the period mentioned is 12 months, but the reality is contract term is only 3 months here. Over. Next one, Chudama. Okay, next one. Combining contracts. Combining contracts, what does it mean is, sometimes what will happen, you will enter multiple contracts with usually the same customer. With one customer, you are entering, let's say 4 or 5 contracts because you can deal with multiple varieties of goods. No? right? Now here, we can offer you CA course, right? And we can make a contract to offer ACCA course also. Same customer, but we are making one contract or two contracts. So that's, if you have entered into multiple contracts, this concept is trying to say, can we combine them? For IND AS 115 revenue recognition, can we combine them? Let's say we have entered 5 contracts with one customer. Should we treat them as 5 for revenue recognition purpose, or can we treat them as 1? So this is what the combining contracts is trying to say, this concept. So as per IND AS 115, what it says is you can combine the contracts. Whether you have entered into 5 contracts, 50 contracts, it doesn't matter. You can combine multiple contracts and treat them as one, provided you have entered the contract with the same customer and nearly same time. What is that? You can combine multiple contracts and treat them as one, provided you have entered it with the same customer and nearly same time. What is nearly same time? They have not defined. Maybe 1 week, maybe 2 weeks delay. Like that's what they are trying to say. Okay. Most of them, it should be with the same customer and both the contracts should have got signed at nearly the same time. Same time does not mean that day only. It can be, I think, practically you can take like 5 to 10 days ka delay is also acceptable in my view. This you'll have to, same time you'll have to analyze it from practical company to company, case to case. Okay, these are 2 conditions plus any one of the following. 2 condition, same customer with the same time plus any one of the following. Any one of these 2 plus any one of the following should be satisfied. Any one of the following means, 1, that contract should be negotiated as a package. You have entered 2 contracts, no? You should have done a package negotiation for them. I'll tell you what that is. Second one, price of one contract. If this fails, you can check the next one, right? Price of one contract depends on the price of the other. There is a price dependency. Third one, they represent single PO. This PO part, we will take it later because it's a separate section. That's a step number 2. That part I will take it. These 2 we can understand over here. Okay, what is this? One second. What is this package negotiation? You know already package negotiation. What is that? Perfect. Now, if you let's say you are the customer, you want to buy multiple goods from me. Sir, if you buy one goods, maybe I will charge 1,000 rupees per unit. Now you're buying one type of goods or multiple variety? Multiple variety. Now you may say, boss, let's say type 1 goods ka contract value is 10,000. For type 1 goods, how much are you supposed to pay? 10,000. Let's say you purchased another type of goods from me, which will cost, let's say, 8,000 rupees. I mean, totally how much is it? 18,000. Okay, we told the customer, since you're buying both, I will give you 16,000. Give me 16,000, it's okay. It's a done deal. Right? This is what we mean by package negotiation. Okay, I've negotiated together. That should be there. Or price of one is dependent on price of the other. One contract ka price is determined by another contract ka price. Like here example, let's say contract 1 you have entered for 10 lakh with the customer. Now contract 2 also is entered 1 week later with the same customer. With the same customer, one more contract C2 is entered. The normal market price of this particular contract is 5 lakh. Normally contract 2, no, we enter into with the customers for what value? 5 lakh. But we told the customer, since you purchase contract with 1 with us, contract 2 ka price I will give you as 4 lakh. Because you purchase contract 1 with us, C2 ka price will be what I'm giving? I'm charging 5 lakh or lesser? Lesser. That's what we mean by price dependency on each other. If one contract ka price, if it is dependent on the other, it's more or less these 2 are same one way if you just check, right? However, in package negotiation, both you will buy it together. Both contracts will happen together. But in price dependency, one will come first, another one will come usually later. But otherwise, more or less, there are similarities between that. Either one of these 2 should be there, or it should be a single PO. Don't worry about what is single PO for the time being. In about 15-20 minutes, I will talk about this PO. PO means performance obligation. This is step number 2. We will discuss this in detail. So if these are satisfied, then you can combine the contract and do 5 steps ka revenue recognition. What is it again? What's the concept first of all? Combining the contract. If you have entered multiple contracts, then you can combine them, meaning you can treat them as one, provided it is entered with the same customer, nearly with the same time, and any one of the 3. That is, it is negotiated as a package, or price of one contract is dependent on the price of other. There is a price dependency between the contract, or they represent single performance obligation. These two plus one of these makes the condition to be fulfilled, and then only you can combine. Combining means then you will apply those 5 steps ka revenue recognition only once. Okay. If you cannot combine means, if you cannot combine, then all the 5 steps for each contracts you need to apply separately and do the revenue recognition. This is about combining contracts. Need a minute or sorted? Okay. Yes, this is a topic which will test your memory for sure. Okay, but the good thing is small questions. All right. So yeah, so you don't have to worry too much about it. It is just that if you know it, more or less you will get full marks in these sort of topics. Next one is contract modification. Okay, sir, you remember we did lease modification, right? So here also pretty much the criteria is pretty much the same. If a contract is modified, okay, first of all, when can you say contract is modified? So you can say contract is modified if the scope of the contract has changed or the price has changed, or maybe both. Either the scope changes happened or a price changes happened. It's the same like what we studied in lease modification. So when can you say scope has changed? For you to say scope has changed, either the quantity or service ka plus minus should have happened, or a term ka plus minus should have happened. What is this? Now let's say earlier the contract we had made with a customer to supply 1000 units of particular product for 6 months. We had made a contract with the customer telling we will deliver how much? 1000 units of a particular product over a period of 6 months. Now the same contract we modified. Now we are saying we will supply 1200 units. So what happened here? Units ka plus has happened. Or from 1000 units we reduced it to 900. So if this units ka plus minus has happened, we say contract ka scope changes happened. That will lead to contract ka modification. Either this should have happened or price change should have happened. Okay, or maybe for it to be a scope change, either unit ka plus minus or term ka plus minus. Here what was the term? 6 months. Initially the term was 6 months. Then we said no, we will supply it over a period of 8 months, or we will supply it over a period of 4 months. So if unit ka plus minus has happened or a term ka plus minus has happened, then we say scope of the contract has changed. Price change I think is self-explanatory. If you have increased the price of the contract or reduced the price of a contract, that will also lead to what? Contract modification. Yes, some people. Okay, the same as lease modification, no change. Now, if contract modification has happened, no, again same. Tell me the lease modification criteria. When lease modification happens, either you will treat it as a separate lease or not a separate lease. Here also same thing. Contract modification, you can treat it as a separate lease. Contract modification, you can treat it as a separate lease. Here you will call it a separate contract. Condition is same. There, when will you treat it as a separate lease? New asset should be added. An increase in the lease payment should reflect the SSP. Here also same thing. If you want to treat contract modification as a separate contract, one new goods or service should be added, because you can also be a service provider, no? So new goods or service should have been added, and the increase in the contract price should reflect the market price or standalone selling price. Same as lease modification. Absolutely no change. Clear, sir? Same ditto. This is absolutely same. Okay, but in order to say it's a contract modification, First, what should have happened? Scope of the contract should have changed or price should have changed. And that change should be approved by all the parties. The buyer, seller, both of them should agree for this change. And the change should be enforceable. If these three are satisfied, then only we say it's a contract modification. First one is what again? Scope changes happen. And when can you say scope changes happen? Either units ka plus minus has happened or term ka plus minus has happened, or a price changes happen. This will be called as contract modification. But in order to say contract modification has happened as per IND AS 115, that modification or change should be approved by all the parties in the contract. Buyer, sellers, all of them should approve it. And that change should be enforceable, legally enforceable. Like here, look at this example. Let's say we have made a contract to buy liquor in the state of Gujarat. As far as I know, Gujarat is a dry state. Right? So selling and purchasing of liquor is banned. Correct? In few states of India, I think it's banned. No, alcohols are banned. Let's say I have made a contract, a seller and buyer have made a contract to buy the liquor in the state of Gujarat. Earlier, the deal was to supply 1,000 bottles. Now it's modified to 1,200. Now you tell me, is this a contract modification? No. Why? It is not enforceable. It's not legally enforceable. Hence, this will not be treated as a contract modification. These are void contracts. You have studied in law, no? Void ab initio. That's what we say, right? At the start only, this is a nil contract because it's not legally permitted to enter into such contracts. That's what this is trying to say. And if a contract modification has happened, you can treat it as a separate contract. When a new goods or service is added and the increase in the contract price reflects SSP. If both of them are satisfied, you can treat this modification as a separate contract and apply all the 5 steps of revenue recognition separately. Your existing contract accounting will not get affected. That is one. Okay, sir. Application of this question is question number 2. Can we review this question? All right. Second one, check. An entity promises to sell how many units of product? 120. Underline that. For how much value? 1,20,000. So 120 units for totally 1,20,000 means the selling price per unit is 1,000 rupees per unit. 120 into 1,000 gives you 1,20,000. The products are transferred to the customer over a 6 months period. So the duration is, we will deliver this 120 units over a 6 months period. Fine. The entity transfers the control of each product at a point in time. So now people, in few questions, you will see something called at a point in time over a period of time. Some question they will say at a point in time, sometimes you will see over a period of time. That is step number 5 ka drama. That is step number 5 ka drama. What does this terminology mean? I will discuss but in step number 5, don't worry about this. So wherever you see at a point in time over a period of time, for the time being, ignore that. In step number 5, I'll tell you what it is. When does it become what? All right. After the entity has transferred control of 60 products. So the contract was to deliver how many units? 120. How much is already delivered? 60 is already delivered. After delivering 60 product, contract is modified to require additional 30 products. How is the modification done? Now you will supply totally 120 product or additional 30? Now 30 goods have been added extra. So goods ka plus has happened. Okay. Now people, if 30 goods if customer wants more, that means we will sell it for totally 120 only or we will collect more money. 1,20,000 was the selling price for 120 units. Now we are supplying totally 150 units. Now 30 more we are selling. So obviously we'll collect more. Okay. At what price now? Now this 30 units, I will sell it at 950 per unit. Earlier the contract was 1,000 per unit. Now it is 950. Maybe the market price of that product is reduced, or we want to give some discount to the customer because they're buying more. Reason could be anything. Which is standalone selling price for such additional product at that point of placing the additional order. So at this, when this modification came, the market value of this product is 1,000 only. That's what they're saying over here. Which is standalone selling price for this additional product at the time of placing the additional order. Now you need to tell me how should you account this modification. No, modification, can you account it as separate contract? Yes, provided 2 conditions are satisfied. What are those? A new goods or service should have come in. Okay, is the new goods come in here? Yeah, 30 product has come in. So new goods have been added. Second one, the increase in the contract price should reflect SSP. Is it reflecting SSP over here? Yes, they told that 950 is the SSP of this product and we are selling this product at 950 only. That means both the conditions are satisfied. Means how will you account this 30 product? For this 30, you will account, for this modification, you will account it as a new contract. So whatever revenue recognition you were doing for the existing 120 product, affected or not affected? The old contractor revenue recognition is not affected. Whatever you were doing, continue with that. This 30 products, you treat it as a new contract and apply all the 5 steps of revenue recognition once again. That's all. And only focus on the pointers that I've written. That's enough. No need to worry about the stories. Okay, enough. If this question same comes, you need to write the provision. Contract modification can be treated as separate contract provided these 2 conditions are satisfied. Then 1 or 2 lines from the case study. What has happened? This is the conclusion. That's it. So don't worry about all the other answer pointers which ICAI has written. They are trying to explain that. So this is good enough for us. Now this question also over. Okay, na sir? Clear, sir? Next concept. Okay. Sir, what if contract is modified and if you cannot treat it as a separate contract? When a contract modification has happened, either you will treat it as a separate contract or not a separate contract. If it is separate contract, what to do? We saw. If it is not a separate contract, how to record it? Sir, if it is not a separate contract, we do an accounting called cumulative catch-up accounting. What is the name of? Somewhere it's there. Here, cumulative catch-up accounting. If it is not a separate contract, we do something called cumulative catch-up basis. Underline that in your book. Now, how does that cumulative catch-up basis accounting works? We will learn it in question number 3. I think once or twice this question has come for 2 marks. For that reason, I'm marking this question as LDR. Third question, keep it as LDR. It's a 2-marker question or a 3-marker question only, but it has come. So let's keep this as an LDR. This cumulative catch-up basis accounting, we're going to learn in question number 3. Fancy term, but easy accounting, to be honest. Now, can we look at that? Now, carefully read the data and try to register the data given. Growth Limited, one company, they've entered into a contract with a customer for infrastructure outsourcing deal. Underline that. Some infrastructure outsourcing we are doing. Maybe some interior work, maybe. Okay, we are doing some interior. Maybe we are an architect company. We are doing some interior work on customer ka building. Could be. We don't know what sort of an infrastructure it is. It could be our data storage wala infrastructure or your building ka infrastructure. Could be anything. We're not 100% sure. Now, the Growth Limited determines, the company determines that customizing the infrastructure will approximately take 200 hours. To do this work, we told the customer we need 200 hours. And how much we are charging the customer? On an hourly basis, we are charging 150 rupees per hour. So 200 hours and 150 rupees per hour. That's what we have initially agreed upon. Okay. So if you multiply, I think you're going to get 30,000. Correct? Huh? 200 into 150 is 30,000. Okay. Now, after incurring 100 hours of time, so 100 hours of work we have already done. Total work time is how much? 200 hours. And that 100 hours of time we have already spent. Now what happened? Growth and the customer agreed to change the aspect of the project. Now they want to do some modification. That increase, due to this modification, they are saying there will be an increase in labor hours by 50 hours. Due to this, right? Due to this modification, now we can't complete the work in 200 hours. We want additional 50 hours, right? Now for this additional 50 hours, are we charging 150 per hour as agreed upon, or we are charging 100 per hour? We are charging 100 per hour. Negotiation. It's fine. That's what we have negotiated. Yes, sir. Now, how this modification we should account it? Okay. The contract modification has happened over here. Fine. Now, for you to treat modification as a separate contract, for you to treat it as a separate contract, 2 conditions should be satisfied. What are those? New goods or service should have been added. Here, it's a service contract that we are giving. New service came in now, or it's the same service only? Same service only. Now there may be customer said that maybe some vastu problem. Instead of putting it on the north side, now you put it on the south side. So due to some modification, right, our time from 200 hours has become 150 hours. From 200 hours, now it has become, or rather 150 or 250 hours. From 200, it has become 50 hours extra. Correct. Now, that means has a new goods or service come in over here? No, it's the same service. Infrastructure outsourcing only is still the service. So new goods has not come in. New service also has not come in. So can you treat this as a separate contract, or it is not a separate contract? It is not a separate contract. If it is not a separate contract, we'll have to do something called cumulative catch-up accounting, CCA. Yes, how to do it? Very simple over here. Everyone understood that it is not a separate contract? That conclusion has everybody been able to draw? Because new service or goods has not come in here. Since new goods or service has not come in, it cannot be, this modification cannot be treated as a separate contract. So it comes under not a separate contract wala category. For that, we'll have to do cumulative catch-up basis accounting. How is it? Very simple. First, whatever numbers they've given, now list it out. Initially, what is the time? 200 hours. How much is the charge? 150. Multiply, how much are you getting? 200 hours, 150 per hour. So total is 30,000. Are we clear? Now, additional how many hours came in? Additional how many hours came in? Additional 50 hours came in. And how much are we charging for this 50 hours? Additional 50 hours of work time we have to incur now. And how much are we charging now? 100 rupees per hour. So how much extra? 5,000 rupees. Totally, are we good? That means what is the total contract price now? Can you tell me? 30,000 plus 5,000. What is the total? 35,000. Are we comfortable? What is the total time? 250 hours. So that means for 35,000 we are charging for how much total time? 250 hours. That means for 1 hour, what is the average rate? 35,000 divided by 250. If you do, you're getting 140. So 140 per hour is what we are essentially charging from our customer. Are we good with that, everybody? Okay. Now, how many hours of work we have already done? 100 hours. Sir, 100 hours of work we have already done means 100 hours of revenue we would have booked. Initially, what was the revenue? See, revenue became 100 or 140 after modification. 100 hours is already spent now. I mean, initially, how much were we charging? 150 per hour. So that means how much revenue have you already booked? 15,000. Do you agree? 100 hours we already work is already done and we were charging 150 per hour. So 100 into 150 is how much? 15,000 revenue we have already accounted so far. Yes. Correct. That means we have booked the revenue at what rupees per hour? 150 per hour. Now after this modification, is the rate per hour 150 or 140? 140. That means how much extra have you booked? We have booked it at 150, but we should book it at 140 because it is not a separate contract. No. So that means basically cumulative catch-up basis accounting means adjusting the revenue. If you have booked more revenue, reduce it. If you have booked less revenue, book more. Here we have booked the revenue at what price? 150 per hour. But after the modification, the price is 140 per hour. So how much per hour extra have you charged? 10 rupees per hour we have charged extra. And how many hours? 100 hours. So calculate how much extra have you booked. This if you calculate, you will get 1,000. That we need to reduce. That's all. That means the net revenue after this will be recorded at what? 14,000. We have recognized 15, but to be recognized is only what? 14. So this 1,000 rupees, whatever extra revenue you have booked, that you need to adjust. That's what we mean by cumulative catch-up basis. Cumulative catch-up is simply means adjusting the revenue. Adjusting here refers to both increasing as well as reduce. Here we have booked the 15. We have to book how much? 14 needs to be booked, but we have booked 15. So 1,000 whatever extra you booked, you reverse it in this period. When this modification happened, you reverse that revenue. That's all this is all about. Comfortable, sir? That's what they've written over here. If you need a minute, I'll wait. If you've got it, we'll move forward. This is the first step. Usually identifying the contract first step is not that very important from examination. In this particular step, this particular question, you could say, has come once or twice it has come. This you could probably keep it as an LDR. Remaining and all, they're not that much often tested. Okay. Yes, correct. Just like valuing the stock under WAC. Correct, Harish. Yeah, you can interpret like that. But it is not weighted average. Okay, in a way it says, you can treat it as we are taking both amount and rate over here. Yes, weighted average you can interpret. Correct. Can I move forward? Everybody in the online, offline is good. Online may any doubt? Wait or proceed? Wait or proceed? Okay, this is done. First step is done. What is first step? Once again, tell me. Identifying the contract. Okay. Now one moment. Let's hang on. So we have done about 40 minutes of our session. Let's have a quick run through of what we have done, or let's have a quick recap so that let's see how much of it we actually remember. What is the standard name? IND AS 115. Revenue from contract with the customer. For every sort of a contract, whether it's a construction contract or whether you are a dealer of goods, you are a dealer of service, doesn't matter. For every entity, revenue recognition will be done as per IND AS 115 itself. And IND AS 115 recommends 5 steps. Recommends mandates that there is 5 steps of revenue recognition. First step, identifying the contract. That's what we studied. Now, basically, contract is basically an agreement between two or more parties, which creates enforceable rights and obligations. Okay, but for you to call it as a contract, few conditions should be satisfied, which we are remembering it as ARPCC. A for contract terms and conditions should be approved or agreed by all the parties. R for rights and obligations of each party you should be able to identify. P for payment terms, when the payment to be made, how much payment to be made, all that you should be able to clearly identify. That's your P. C for contract should have a commercial substance, because due to this contract, cash flow should change. Another C, consideration collection should be probable, meaning by the seller should have a reasonable assurance that we will collect the money from the customer. That is the first step we'll discuss. Next, we looked at contract term. Usually, contract term is the term or the period mentioned in the contract. Whatever is agreement period, that only is usually contract term. But in some cases, it can be lesser. So basically, you will check for how much duration, enforceable rights and obligations you can have. That period becomes your contract term. That is one. Next, we looked at combining contract. If you have entered multiple contracts, then can we combine them and treat them as one for revenue recognition purpose? Yes, provided three conditions are satisfied. Two. First is what? The multiple contracts should be entered with the same customer and at the same time, and any one of the following three. What are the three? There should be a package negotiation, or price of one contract should depend on the other, or they should represent a single performance obligation. That is one. Then contract modification. Contract modification means some scope changes happen or price changes happen. When can you say scope changes happen? Either unit ka plus minus, number of units called out in the contract, or number of service mentioned in the contract has increased or reduced, or the term ka plus minus has happened, or price change should have happened. Now, if you want to account it as contract modification, one, this modification or change should be approved by all the parties and it should be legally enforceable. Now, whenever there is a contract modification, either you will treat that contract modification as a separate contract or not as a separate contract. If you want to treat it as a separate contract, two conditions should be satisfied. One, a new goods or service should have been added. Since the new goods is added, will the same contract price hold good or contract price would have increased? That increase in the contract price should reflect the standalone selling price. SSP we have already studied. SSP means the market value. Individually, if you sell the product, what is its value? That only we call it as SSP. We studied this in lease, same drama. Okay. Now, if you cannot treat it as a separate contract, we do an accounting called cumulative catch-up basis accounting. This is nothing but you are adjusting the revenue. Either increase or reduce the revenue. That's what is nothing but cumulative catch-up basis accounting. This is your step number one, all the questions and all the drama. Can we move over to step number two now? Step number two is quite important. Okay, it's a good case study question for a 2-marker. Usually, yes, you can expect the easily floated topic very easily can be combined in the multidisciplinary case study. What is this? Second step is identifying performance obligation. Performance obligation going forward, I'll refer it to as PO. What is this? I've just written a small pointers and some examples. Let's understand this. Sir, performance obligation in a very simple terminology means promise. Performance obligation simply means promise. So second step is you need to identify how many promises seller has made to the customer. How many promises seller or service provider has made to the customer. Identifying that is the second step. Okay, na sir? Alright, first I'll tell you the definition, then we'll take through some case study. No need to write all this. We have enough questions, so we'll anyway sort it out. Okay. Performance obligation, basically definition of performance obligation is it's a promise made in the contract with the customer. It's a promise made in the contract with the customer to transfer a distinct goods or service or a series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. Fancy term. Okay. Easy meaning. Okay. I'll tell you once again. Performance obligation is basically a promise made in the contract with the customer to transfer a distinct goods or service or a series of distinct goods or service which are substantially same and have the same transfer pattern to the customer. Now, what is this? Very simple. Or maybe this also I'll tell you. So, if you want to call a goods or service as distinct, it is same as LVA. Remember low value asset which we discussed in IND AS 116? What are the two conditions of low value assets? One, the lessee should be able to use the asset on its own or with the existing resources. And the asset should not be highly interdependent or interrelated. Same thing here also. If you want to call a goods or service as distinct, the customer should benefit from using the goods or service on its own or with the existing resource of the customer. And this goods or service should not be highly interrelated or interdependent. Basically, if you want to call a goods or service as distinct means, because sometimes what happens, you will sell multiple goods. Like let's say I purchased mic and camera. I purchased a mic and camera. Is mic or camera same? or can be used separately? We can use it separately if you want. Right now we are using it together, but if you want, we can also use it separately. Then it's a distinct goods or service. If it is interdependent goods, then they will not be considered as two. They will be treated as one for revenue recognition purpose. Okay, that's what is the second condition is trying to say. Basically, customer should be able to use the asset independently. That those goods or service should be basically independent. That's what first condition is trying to say. Yes, sir. Let's stop a minute there. This is the actual definition, and POCA definition, I suggest you should know it, because POCA case studies is generally expected in exam. So if it comes as a descriptive, you need to remember and call out this definition. If it comes as an MCQ, right answer is enough. But if it comes as descriptive, you may have to remember. For the time being, let's forget this definition. Let's try to understand it in simple terms. Performance obligation in a very simple terms means what? Promise. So second step, all you have to do is identify how many promises. How many promises? Let's take up a small case study. No need to copy, just listen. Let's say A Limited has made a contract with a customer called C Limited. A and C have made a contract. What is this contract for? A will sell modem and broadband connection for 1 month to C Limited. A Limited is the broadband service provider. Okay, maybe Airtel or Jio or whatever, right? They have made a contract with another company called C Limited saying A will give broadband connection to C for how many months? 1 month. Okay, and to get the broadband connection, we know that we need modem. A will also sell the modem to C Limited. Yes, everybody? Okay, so far how many promises are there in this contract? Forget about this next lines. So far it looks like how many promises have you made with the customer? 2 promises. What are those? One to sell modem, another one to give broadband connection. So far 2 promises are there. But don't forget, if you want to treat them as separate, they should not be interconnected or interdependent. Meaning you should be able to use modem separately, broadband connection separately. If modem and broadband connection, if it is interdependent, then it will not be 2 PO, it will become 1 PO. Yes, sir. Now let's read one more data. Modem and broadband connection are not interdependent. The question will mention all this. So here broadband and modem are interconnected or not interconnected. Meaning customer need not buy modem from us. Customer can only buy what from us? Broadband connection. If they have any other modem, if they already have modem, right, that modem can be used for our broadband connection. That's what we are trying to say. Basically, any company ka modem works for our broadband connection. Customer need not buy the modem from us only. That's what I'm saying here. Customer need not purchase this modem from us. They can buy it from anybody in the market. It works. Now you tell me, sir. Modem ka cost, let's say, is 2000. Broadband connection ka cost is 1000. So totally I have made a contract with the customer for how much value? 3000. That is what we call it as transaction price. So the contract ka value is how much here? 3000. Fine. Now, how many POs are there in this case study? 2 promises, 1 promise. Identify that for me and tell me with all this data. You just need to identify that. 2 PO or 1 PO? 2 PO. 2 promises. How? Why is it not 1? So this modem and broadband connection, if it is interrelated, if it is interconnected, interrelated, interdependent, then they will not be 2. They will become 1. Because customer cannot use them independently. If you want to treat them as separate performance obligation, customer should be able to use it on their own. Now here for broadband connection, only our modem is required or any modem works? Any modem works. And customer need not buy modem from us alone. They can buy it from anyone in the market. We can give only broadband connection also. So hence these are what? Highly interconnected asset or not interconnected in this example. In this example, it is not highly interrelated. Yes, so that means how many POs in this particular contract? There are 2 performance obligation. Okay. Now this is the one of the most important steps in revenue recognition. So on paper, no, this looks like very false. What promise, sir? Poor. Yeah. But look at the revenue recognition significance. A slight change can impact the revenue recognition for crores together. You're talking about broadband Jio and all, a slight here interpretation can make crores of revenue recognition difference. Why? Okay. If it is 2 performance obligation, if it is two performance obligation. Now I'll just tell you one, just for your reference. I'll tell you step number 5 ka guidance. As per IND AS 115, you'll recognize revenue when performance obligation is satisfied. When PO is satisfied. Okay. Now people, when can we say our promise relating to modem is satisfied? When we deliver the modem. The moment we deliver the modem to the customer, as a seller, our obligation is complete. So in this 3000 total contract value, how much is relating to modem? 2000. That means what? Since modem I have given it to customer today only, with respect to modem, as a seller, my obligation is complete. So I can recognize modem ka revenue recognition day 1 itself. Today only, on day 1 itself, my modem related performance obligation is satisfied because I have delivered the modem to the customer. That was my obligation and I have fulfilled it as a seller. So you can recognize the revenue on day 1 itself. But what is second performance obligation? To give broadband connection for 1 month. So how much is the broadband connection related revenue? 1000. Can I recognize this 1000 ka revenue recognition day 1 itself or day 30? On day 30th, I would have completed my broadband ka obligation. So that means this ka revenue recognition will happen on day 30th. Are you getting the difference? So if you treat them as two performance obligation, then 2000 ka revenue recognition will happen today itself. 1000 ka revenue recognition will happen on day 30th. Yes, everybody good. Now let's modify this example here. Check. Suppose same case study. Suppose modem and broadband connection are interdependent, which is usually the case. If you have taken Geo broadband and all, you will know. Any broadband will not work. They will say only my company ka broadband and only my company ka modem. Right? That's how usually the service providers are offering this service now. You can't use any random modem. I have Geo connections. I can say with certainty. I asked them. I had already had a modem. Right? I asked them, will that modem work for Geo? They said, no, sir. You have to buy our Geo ka modem only. So if you want a Geo ka broadband connection, you have to buy Geo ka modem only. That's what they suggested. Yes, sir. That means now you tell me, this modem and broadband connection are not interdependent or it is interdependent. You cannot use them separately. Any random company ka modem will not work. I have to buy Geo ka modem only, and that only will get fitted with Geo ka connection. Right? I mean, these two become what now then? Interdependent or interconnected. If it is interconnected, you can't use them separately. If I want to use Geo ka modem, I need to have Geo ka broadband. Right? And if I want Geo ka broadband, I need Geo ka modem. That means both are what? Go hand in hand. In that case, you don't have two performance obligation. They become what? One performance obligation. If they are interconnected asset, then they become what, sir? One performance obligation. Yes, sir. Now, what is the transaction price? Same, 3000. In this 3000, 2000 for modem, 1000 for broadband. Since it is one performance obligation, IND AS 115 says you can recognize revenue only when performance obligation is satisfied. Now, this performance obligation, though I have delivered the modem today, can customer use the modem today itself or they need a broadband connection also? They can't use modem alone. To use modem, they also need a broadband connection. Hence, they are interdependent or interconnected assets. How many PO? One performance obligation. Now, this one performance obligation will be satisfied now or on the day 30th. That means now, day 1, you cannot recognize any revenue. You can recognize full revenue only on the day 30th. Getting the significance here. Huh? See, if it was two performance obligation, modem related revenue you recognized on first day only. Broadband connection revenue you recognized on 30th day. But if it is one PO means no revenue will get booked on day 1. Revenue will be booked only on the day 30th. That is the significance. Okay, so that's the reason this is the most important step. How many performance obligations are satisfied? Because once PO is satisfied, then only you can recognize the revenue. That is your step number 5 ka drama. That's the significance. Yes, sir. So it's the second step. I just told this just for your understanding purpose. Huh? There are some steps for revenue recognition also. When is PO satisfied and all. But just say, this is the significance. At this step, we'll only be concerned about identifying the promises. Are we okay with everybody with this so far? Pakka? Online also, can you confirm? So far good? So far are we good? Now once again, maybe we'll call out the definition. Performance obligation means what, sir? Let's try to remember now. Performance obligation means It's a promise made in the contract with the customer. What promise? To transfer a distinct goods or service. Distinct goods means separate goods or service. And when can you say a goods or service is distinct? When the customer can benefit from using the asset on its own. The customer should be able to use the goods or service on its own or with the resources available with the customer. And the goods, if you have supplied multiple goods, the goods should not be highly interrelated or interdependent. If they are interrelated, interdependent, then they are not multiple POs. They become one PO. If they can be used separately, independently, then they are separate POs. If they have to be used together, then they become one PO. That's what we mean by distinct goods or service. Yes, sir. This is what we have covered in 2 case study examples. Now this one I'll come to it in a bit. So far this one is okay. Alright, let's look at another case study. Look at case number 3. Let's say A Limited and Z Limited, they have made a contract that A will supply 1000 apples for 1 lakh to A Limited. A is an apple dealer. They made a contract with a particular customer to supply how many apples? 1000 apples for a total value how much? Now each apple is separate. You have to consume all the 1000 together, or you can have one by one. You can have one by one. Correct. You can eat one by one. You can sell one by one. You can use them independently. Yes, no. That means 1000 performance obligation. You may say 1000 performance obligation. Sir, if it's a performance obligation, if it's a 1000 performance obligation, means step number 1 to step number 5 revenue recognition is there. No, you have to apply 1000 times. For one apple, one journal entry. Pass. One apple, one journal entry. Right? Like this, we will make one contract or we will make hundreds and thousands of contracts. Here, that's the reason they did not stop at first definition. If they had stopped at first definition, first person is accountant would have left the job. Sir, 1000 apple, one journal entry, one apple means, his whole life will go on passing journal entry only. Right? No, it will not be possible. Practically, it is not feasible. Yes, in this example, all the 1000 apples are distinct. They are separate. They can be used separately, consumed separately, sold separately. But practically, you can't account them as 1000 performance obligation and pass 1000 journal entries. Right? That will not hold good. Practically not at all feasible. Hence, in performance obligation, they brought in one more feature. What is it? A series of distinct goods or services which are substantially same and have the same transfer pattern. Second one, once again, what is that? A series of distinct goods or service, but they are different, but more or less they are same. They are substantially same and have the same transfer pattern. So if they are more or less same and if their transfer pattern is same, means you don't have to treat them as 1000 apples as 1000 performance obligation. They become what? One performance obligation. Now in this example, it may be 1000 apples, but at the end of the day, it is apple only. No? Of course, apple number 1, apple number 10 are different, but more or less they come in which category? Apple category only. No? It is not apple and mango. It is still what? Apple. That means they are substantially same and have the same transfer pattern. Same transfer pattern means now A Limited will sell this apple to Z Limited. A Limited will transport this apple to Z Limited. One apple, they will send in one lorry. No? One apple, they will send it in one lorry. Take diamond apple, take. Will we do that, or we'll put all the apples in one carton box? All the apples will put it in 1 or 2 carton box and send it. That means transfer pattern for all these apples are different or same. The transfer pattern means the way we are delivering these goods. The way seller is delivering the goods, different or same. That means they are substantially same. If the products, if they are substantially same and the transfer pattern is also same, you will not treat them as 1000 performance obligation. It becomes what, sir? Single performance obligation. Though we have 1000 apples here, everything will be treated as one performance obligation. And step number 1 to step number 5 for revenue recognition will be done only once. That's all a second definition ka feature. Understood, everybody? Okay. That means if a mic dealer sells 1000 mics, right? Is it a 1000 performance obligation? Because substantially they are same. Transfer pattern is also same. So it will be treated as what? One performance obligation. That is what second feature of performance obligation is trying to say. Okay, now look at this case study, case number 4. There is a cable TV operator. right? These days people hardly are using cables. No, cable is gone. I think a forgotten scenario. I think I think there was one question on this, so that's the reason I thought about it as a case study. There is a cable TV operator. They are giving 100 TV channels to the customer. When you opt for cable, you will get TV channels. No? So 100 TV channel cable operator is giving to the customer a service. Cable TV operator is giving to the customer. Now each channel is separate. One is a news channel, one is a sports channel, another one when drama is going on, series is going on. All are different. That means, will you treat this 100 TV channels as 100 performance obligation or one performance obligation? Sir, 100 TVs, you will get it through 100 cables or everything will be delivered through one cable only. Through one cable only. They are substantially same and have the same transfer pattern. So here, though we are giving 100 TV channels to the customer, it will be treated as what? One performance obligation. Because they are substantially same and have the same transfer pattern. That's the reason. Clear, sir? That's all it is. If we are selling a car. You'll have to just check. If you are selling 10 cars together, you can treat it as one PO also, if the transfer pattern is same. Or suppose one car you are delivering to Bengaluru, one to Hyderabad, one to a different city, then it will be a different one. You'll have to analyze the case, right? So again, there's one common answer to that. But to a single customer, to a single location, if you're delivering 2 cars, right? You could say transfer pattern is same, you can treat it as one PO. You'll have to analyze it on a case-to-case basis. Everybody so far okay? And now, once again, we will call out the definition. Then there are about 2 to 3 questions. You will identify the PO in that case. Okay. Okay. Tell me PO ka definition once again, people. Performance obligation means it's a promise made in the contract with the customer to deliver what? A distinct goods or service. Distinct means separate goods or service. When can you say a goods or service is distinct or separate? When the customer can benefit the asset by using the asset on its own. That goods or service customer should be able to use on its own, right? And the goods or service should not be highly interconnected or interdependent or interrelated. That is one. Or second part is, it's a promise to transfer a series of distinct goods. Series of distinct goods or service means many goods and service, many different goods or service, but they are substantially same and have the same transfer pattern. If they are substantially same and have the same transfer pattern means, then will you treat them as 1000 apples as 1000 performance obligation or one PO? They will be treated as one performance obligation. That's all. Okay, with this, let's go for some questions. This is your definition. That's okay. Come to question number 4. You identify here. Okay. I'll check. Don't read the solution. I'll call out the question. You tell me how many performance obligation here. Performance obligation simply means the promise. Identification of promises is what we are doing in these questions now. A construction service company enters a contract with the customer to build a water purification plant. Aquaguard we are building. Okay. Maybe fancy aquaguard we are building for one customer. That's the service we are offering to the customer. One asset we are building. Okay. A company is responsible for all aspects of the plant, including overall project management, engineering, design service, site preparation, physical construction, procurement of pumps, equipment to testing, blah, 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 they told. So if you want to build an aquaguard will have various small parts, right? So you need to hire laborers for it. You need raw material for it. Now they're saying to construct this water purified plant, we need to do all this service also we need to do. All these assets also we need to procure. Now they are saying whether the contract has a single PO or multiple PO. Single PO, because to execute this water purification plant asset or service, we need many other raw materials and other service also we need. We need labor service, we need raw material, and some pump, gimp and all equipment we need to buy. So maybe some intangible asset like license we may have to buy. We don't. Some softwares we may have to buy to test the water TDS level or whatever level it is. All that we need. So because we are giving all this service also, all this service, will you treat it as one PO or separate PO or this still based on one PO? Sir, the site preparation, this pump, gimp and all can customer use on its own. And first of all, customer asked for all this. No, customer asked us what? Give me water purification plant. How we build that water purification plant is our headache. For this, we may need hundreds of raw material, hundreds of laborers. That is our headache. We made up one promise to customer. What is that? To deliver water purification plant. For this plant, we need to do internally many activities. That's our headache. But customer, we made a promise only to deliver the water purification plant. How many PO? So in this contract, when there are one performance obligation. Why not? Because all this customer cannot use it independently. If customer wants to use this pump and all, they have to use it along with what? AquaGuard. So these are what, in fact, all these are interconnected assets, interrelated assets. So they are not separate POs. They become one PO. Like a car. If a Hyundai sells a car to a customer, right? Let's say for 10 lakh. So customer told, I want car. But in order to build the car, Hyundai has to have 4 tires, one Stepney, one extra, right? And then we'll have steering wheel, music system, or engine. All these are separate PO. Na? Car will have obviously 101 parts. Can customer use the engine alone without car? No, all these are interconnected assets. Yes or no? That means what? There will be one POs. That is what is this example. Yes, sir, Ji. So final answer is it's a one performance obligation. Can we go to the next question? 119. Don't worry about story. If it comes, we'll write PO ka definition. Then facts of the case and this conclusion. That's all. No need to worry about ICAI ka story here. Sir, for construction, Advait is asking, sir, for construction contract, this standard is applicable, sir? Yes, sir. For goods, for service, for construction service, for every revenue recognition will happen through IND AS 115. It's this standard. You don't have any separate standard for architects and construction contracts at CA final level. Everything in IND AS 115. Okay. Look at question number 5. Again, same thing. You need to identify how many POs. This we have already covered. An entity provides broadband service to customer, internet service, along with voice call service. That means so far it looks like how many promises? 2. One is broadband, another one is voice call, phone, train. Customer buys modem from the entity. That means another promise got added, which is modem. First we'll identify, then we will figure out whether they are separate POs or one PO. So far 3 things we have identified: broadband, voice call, modem. However, customer can get the connection from the entity and modem from another vendor. So for our broadband connection, customer should buy our modem only or any modem works. That's what they're saying here. A customer can get the connection from the entity, means us, and modem they can buy it from anybody else. That means this modem and broadband connection, are they interrelated or independent? Sir, if they are interconnected, they become single PO. Here, are they interconnected or they can be used separately? You can use separately because you don't have, customer need not buy our modem for our broadband connection. Any other modem also works. The installation activity requires limited effort. That means installation amount is very immaterial. Otherwise, installation also becomes a separate PO. But here they are saying it's very insignificant, so we can ignore that. It has various plans. It means the service provider, seller. We have various plans where we provide either a broadband or voice call. You know, remember earlier there was a broadband plans where the entities used to tell, if you want internet connection, you have to take our telephone service also. Back then, about 5 to 10 years back, this was a drama. I don't know whether you are aware or not. So I think Airtel launched this plan. You want broadband from us? Buy our telephone. Because back then, no, I think maybe long before, landline connection was there. BSNL, you remember now? You remember there is a company called BSNL? Right? So earlier, about 15-20 years ago, most of them had BSNL internet connection. But in order for the internet connection, BSNL to take internet connection from BSNL, you also had to have telephone connection. If you didn't have telephone connection, they never used to give broadband also. But here, is that the case? No. The entity has many plans where you can either take broadband service or you can take voice call service or you can take both. I mean, these two go hand in hand. Are they interconnected or customer choice? Customer can go only for broadband or customer can buy only voice call service from us. Or if they want, they can buy both. That means we are selling this separately means what? Are they interconnected or are they independent? They are independent. So how many POs you tell me, sir? None of them looks interconnected. None of them are interconnected. Sir, if all of them are interconnected, then they become single PO. Are all interconnected or all of them are separate? That means how many POs here? 3 performance obligation. What are those? Broadband, voice call, modem. That's all is identification. Over. Next. Okay. All right. Next question. Pakla. Question number 6. Simple. All these questions are okay. An entity is a software developer. They entered into a contract with the customer to transfer a software license. So we will transfer a license, software license to customer. One PO. So far we have identified. Then we will perform installation service. Second PO. Second promise. And provide software ka updates. Third promise. And also we'll give some technical support for a 2-year period. How many promises? So far we have identified 4 promises. Now the question is, should we treat them as 4 separate PO or 1 PO? If they are all interconnected, then if they are all interrelated or interconnected, then they become 1 PO. If they can be used separately, if they are not interconnected, then they'll become 4 separate PO. Let's see. The entity sells license, installation service and technical support separately. That means all the 3 customer has to buy from us together, or they can be bought individually. Sir, if they can be bought individually, that means they are not interconnected. Because individually, if you are able to buy, then each of them are separate. So far, what's the license is separate PO, installation service separate PO, technical service also separate PO. The installation service, so okay, includes changing web screen, blah blah blah. They've said that's okay. Installation service is routinely performed by other entities and does not significantly modify the software. So customer need not take installation service from us. They can also take it from others also. And we have already know this, that installation, license and updates are separate PO. Now the only thing is technical support. What did they say? The software remains functional without updates and technical support also. For the software to work, technical support is absolutely required or customer choice. Customer want means they can go for technical support, or even if you don't take technical support, license will still work, software will still work. That means again these two are interconnected or not interconnected. That means all the components are what here? Separate. There is no interconnection between them. So how many promises? 4 performance obligation. What are those? License, installation, software updates, technical support. 4 performance obligation called out here. That's all. Just pure identification. If anywhere here, if they are talking about revenue recognition, don't worry about that, because we are in step number 2. We will not talk about revenue recognition. But you know the significance of PO, correct? If performance obligation is satisfied, you will recognize revenue today only. If it is not satisfied, then you will delay the revenue recognition. That's the reason identifying the performance obligation is quite important. Okay, this is done. Can we go for the next one? Now, this next question I would say is important for a 2 marker or a 4 marker, it depends. 4 marker means you need to put some provision ka blade. Calculation is easy. What is this? I'll give you a quick background. No need for all this. I'll tell you and then we will directly take up a question. Now people, where do you go for shopping? You go for shopping. You never go for shopping. We only go for our client's place. It's like our life has become a full agenda, sir. Only client, only office. Yeah, nowhere else. Okay, let us say we went to one shopping mall. Yeah, maybe we went to PVR. I think here close by is PVR. You know, some Inox mall or some mall we went. Okay, Vega City Mall. Right. Okay, we went to Vega City Mall. Okay. Inside Vega City Mall, let's say we saw there is a Reliance center. Reliance ka, what is that? The clothing center? What do they call it? Reliance Trends, I think. No? Reliance Trend. So inside Vega City Mall, let's say you went into Reliance ka Trend. Okay. You thought, let me do a shopping. Right? Too much client, too much customer headache. Let me at least shop for myself and feel a little better. So you went for shopping. Okay. There people, let's say you did shopping worth 10,000 rupees. Your what? 1 day ka stipend? Oh, 1 month stipend. Oh, man, 1 month is also good. 10,000 1 month is good. For us, it was 1,000 per month. So I think 10,000 is better only. Anyways, so you purchased goods worth 10,000 rupees. Okay. Normally, if you observe, when you buy a certain quantity or certain value worth of goods, right, the shopping malls gives you one voucher. They give you shopping voucher. That we're calling it as DV. DV as in discount voucher. Because you did shopping worth 10,000, you got a discount voucher worth how much, sir? 500 rupees. Now this discount voucher, now you can redeem it for your future purchase. Next time when you buy, next time let's say you purchase goods worth 5,000. You don't have to pay 5,000. You can utilize 500 ka discount voucher and pay only how much? 4,500. That is the utility or use of discount voucher. Correct so far? Now think from Reliance perspective, Reliance trend perspective. 1 PO or 2 PO? 1 PO is goods. Discount voucher also should be treated as a separate PO or not? Understood? I'm not expecting an answer from you, but did you get the concept? So in this contract, is goods is one performance obligation and discount voucher is separate PO, or they are one performance obligation. That is the concept we are about to study. Are we good with this so far? Now for this, let's do a thing. Instead of worrying about all these points, I've written some points over here. In fact, this is also not required so much, right? So, but maybe once, since I've taken so much of efforts and written on this, once I will read it out. Okay. All right. Discount voucher wala question or DV question. If when discount voucher question comes, what to do? I've just called it out for your reference there. Okay. Sir, first step. Discount voucher can be a separate PO, provided if it offers a material right. Discount voucher can be treated as a separate performance obligation, provided it gives what right? Material right. Material right means what? Means, sir, everybody should not get the discount voucher. Only if selected few customers by purchasing a certain value of goods, if they are getting discount voucher, then we say discount voucher offers what right? Material right. Now let's say Reliance has a general discount of 10%. They have a general offer going on where what is the discount percentage? 10%. This what everybody is getting. Now this, in this case, DV will not be a separate PO because everybody is getting it. Suppose Reliance says you will get 40% discount only if you purchase goods worth 5,000. That means every customer will get this 40% discount, or only those customers who purchase 5,000. Only those customers who make a purchase worth 5,000, only they will get 40%. In that case, we say discount voucher offers a material right. That's what next point I've written over here. Material right is offered if a customer gets this right only by entering into a particular contract. Only by selected customer by entering into a contract with a particular value, get this MR. In that case, we can say discount voucher offers a material right and it can be a separate PO. Okay, na sir? That's how to identify. Okay. All right. Next, what you'll have to do is find out that material discount voucher ka percentage. Now here, let's say, sir, a particular customer got how much percentage discount? 40% discount. But Reliance now is offering 10% general discount to everybody. That means you tell me by entering into this contract, though the customer got 40%, 10% discount is offered to everybody. That means effectively how much discount percentage this customer is getting as extra? 30%. That you need to find out. How did you find 30? 40 minus 10. That's what I've written over here. If you want to find material right ka discount percentage, take the total discount percentage, which is 40, minus the general discount percentage if it is given minus that. That means you will take the value as what? 30% for our calculation. Then you need to find out SSP of material of this discount voucher. How do you find out what is SSP first of all? Full form is what? Standalone selling price. So you need to find standalone selling price of the discount voucher. How do you get that? Now this discount voucher, can customer redeem it now or in future? This discount voucher can be redeemed only for the future purchase. So they in the question they will say, what is the future purchase value expected? Reliance would be doing this transaction since many times. No? So they will know on a general how much the customers will buy in future utilizing the discount voucher. Take the future expected purchase value. Okay. Multiply by the MR discount percentage. Multiplied by the probability percentage, which will be given to you in the question. This becomes the SSP, right? Find out the find out the standalone selling price of the goods, or maybe, hang on, I think this will not make sense to you. Let's take up a question, because what we do in the question I've called out here. So right now, I think after this, whatever steps if I tell, you may not get it. So let's do a thing. Let's take one question. Question number 7. Keep it as LDR. Okay. Don't worry. Whatever I've written here, it is question ka steps. In fact, you don't need this also. You can directly solve it without the steps also. Check. Question number 7. An entity enters into a contract to sell a product A for how much value? 1000. This is our transaction price. So we have sold a particular product called product A to a particular customer for how much value? 1000 rupees. So the contract value only we call it as transaction price here, TP. As part of the contract, entity gives a customer 40% discount voucher. Okay. In this discount voucher, we know it can be utilized only for future purchases up to 1000 rupees. So this discount voucher, customers can redeem it for the future next time when they purchase it. Okay. But he has to redeem it within next 30 days. The discount voucher has a validity. Within 30 days only you need to make another purchase and utilize discount voucher. Otherwise, discount voucher will get lapsed. That's the terms and condition. The entity, that is a seller, intends to offer 10% discount on all sales for the next 30 days as part of seasonal promotion. That means for everybody we give how much discount? 10%. But to this customer, how much did we give? 40%. That means how much extra this customer got? 30%. That is nothing but your material right of this discount voucher. General discount voucher, you should not be able. First of all, first point again, discount voucher, you can treat it as a separate performance obligation provided selected few customer will only get it. Here everybody will get 40% discount, or they have to buy a particular product. They have to buy a particular product A, and that too specifically for 1000 rupees. If you don't buy product A, or if your purchase value is less than 1000, maybe you will not get this 40% discount voucher because it's a selected promotion. But everybody will get how much discount? 10% discount. That means this customer, by entering into this contract, how much extra they got? 30% extra. Now 30% will be the discount voucher ka percentage value. Okay. All right. The 10% discount cannot be used in addition of 40%. Totally it's 40. In this 40, 10 is included. I mean, this customer effectively got how much extra? Only 30% extra. The entity believes that, the entity, that is a seller, believes that there is a 80% likelihood, meaning 80% probability that customer will redeem the voucher. Because customer has to redeem within the next 30 days. No? So they are saying there is an 80% chance customer will utilize this discount voucher by buying the goods. And how much purchase customer will make in the future? Check have they given. On an average, customer will buy 500 rupees of additional product. In the future, customer will buy how much worth of goods? 500 rupees. And there is 100% chance of buying or only 80% chance? 80% chance of buying. Determine how many performance obligation and their SSP and allocated the transaction price. This is actually a full-fledged revenue recognition problem, but it's okay. We'll do it off. First, look at the solution where it is here. Now, can you treat it? No need to write anything. It's a very easy question. Just I've written the provision. If it comes as a 5-marker question, how to solve, I've just told it with the provision. Okay. If it comes as 2-marker, you can only do this part alone and directly this one. Last 2 steps are more than enough. But I've written provision thinking it as a 5-marker question. First, discount voucher, can you treat it as a separate performance obligation? Yes, provided it offers one right. What right is that? Material right. Material right means what? Only selected few customers should get it by entering into a contract. Okay, it should not be a general discount. It should be a specific discount given to a specific class or few customers. So here everybody gets how much discount? 10% general discount. But this customer got how much? 40%. Correct. That means discount voucher is a separate performance obligation to the extent of 40% or to the extent of 30%. To the extent of 30%. Only 30% this customer got extra. No? Rest everybody got 10. Okay. That's what I've written here. Since discount voucher gives a material right, discount voucher in this problem will be treated as a separate performance obligation. I mean, stop. How many POs are there in this contract? 2. What are those? Goods. One, we have an obligation to deliver the goods to the customer. Now, goods is one PO. Another one is discount voucher is a second PO. There are 2 performance obligations. Okay. Goods and discount voucher. Clear, sir? What is the transaction price? We already identified. TP is 1000. Okay. So if discount voucher is a separate performance obligation, means you need to find out SSP of the discount voucher. In fact, I've written here. This contract has 2 performance obligations. One is the main product A, another one is the discount voucher. Now, people, maybe once again, maybe I'll call you 5 steps of revenue recognition, which maybe help you fulfill for this question. What is first step? Identifying the contract. Second one, identifying performance obligation. Here there are 2 performance obligations. Third one, determining the transaction price. How much is the transaction price here? 1000. Okay. Fourth step is the transaction price should be allocated to all the performance obligation. What does that step once again? The transaction price, if you have two performance obligation, means whatever you got transaction price, no, it should be allocated to all the performance obligation. That is the fourth step, allocation of TP among the POs. Fifth one, you recognize revenue when performance obligation is satisfied. When PO is satisfied, you recognize the revenue. Okay, sir. Now here there is a contract. If they don't tell anything, we'll always assume that contract ARPCC is satisfied. What is the second step? Identifying PO. Did we identify PO? Yeah, here there are two POs, main product A and discount voucher. Third one, determining the transaction price. How much is transaction price or contract price? 1000. Okay. Fourth step is what? This transaction price of 1000, no, it's not relating to 1, it's related to 2. So hence this 1000 should be allocated. Some portion of 1000 will go to product A, some portion will go to discount voucher. So that allocation should happen in the fourth step. And how is that allocation done? That allocation we do in SSP ratio. We allocate in SSP ratio. SSP means stand-alone selling price. Stand-alone selling price means if you sell product A alone, without discount voucher, if you sell product A alone, how much will you sell it for? Obviously 1000. Here you have sold product A only, no, for 1000. But discount voucher came as an extra. So what is the SSP of product A? 1000. Because here we have sold 1000. You also need to find out SSP of one more. What is that? Discount voucher. SSP means full form is what, people? Stand alone. We discussed this in lease also. Once again, it's coming here. Stand alone selling price. Stand alone selling price means individually if you sell the product. Here there is a combo, no? Two has come in. Product A and discount voucher. Individually if you sell, what is their value? That individual value or individual sale value, we call it a standalone selling price. Here A we sold, A only we sold here. Discount voucher came as an extra fitting. A we sold for how much? 1000. So standalone selling price of product A is 1000 only. Next step is to find out standalone selling price of the discount voucher. How to find out? Very simple. Take your calculator. Discount voucher, no, customer can use when now only or when he purchases in future. When he purchases in future. How much will he purchase in future? 500. There is a 100% chance of customer may buying this 500 rupees worth of goods or only 80%. 80%. Multiply that. How much discount voucher this customer got? 40%. But everybody got 10%. I mean, this customer got how much? Material right extra? 30%. So multiply 30%. How much are you getting? 120. This is your standalone selling price of discount voucher, which I have expressed as formula. Understood? Tell me what is the formula now? If you want to find standalone selling price of discount voucher, what's the formula? Future purchase value multiplied by probability percentage multiplied by total discount or material right ka discount. Material right ka discount. How do you get material right? From the total discount, reduce the general discount. That you will get the material right ka discount. That's what we have done over here. I have told it as formula here. Check. Expected future value 500 multiplied by probability percentage multiplied by MR discount percentage. And how do you get MR discount percentage? Total discount percentage minus general discount percentage. So SSP is 120. Any doubt in this? Now what is the transaction price? Or 1 minute. Any doubt till here? Any doubt till here? Anybody? No? Okay, now very simple. What is the transaction price? 1000. That transaction price of 1000 should be allocated to all the PO in what ratio? SSP ratio. What is SSP of main product? A, 1000. What is SSP of discount voucher? 120. What is the transaction price? 1000. The transaction price of 1000 will be allocated to main product A and discount voucher in their SSP ratio of 1000 is to 120. So 1000 rupees you allocate in this ratio. So how much transaction price will be allocated to product A? 1000 in this particular ratio. 1000 into 1000 divided by 1120. If you add this, you will get 1120. No? So how much is it? 892. So how much transaction price will be allocated to discount voucher? The balance. 1000 minus 892 you can do, you will get 108. Or 1000 you allocated again in this ratio, which is 108. Correct. Subject to round off, it's fine. Correct. What is the significance of this? Sir, main product A obligation entity has already fulfilled. Do you agree with me? Product A we have already delivered. Means 892 ka revenue should the customer, should the entity wait or book it now only? Revenue on product A 892 is recognized when the control is transferred. Meaning when you deliver this product, that day only you can recognize the revenue. We gave the delivery today only, no? That means 892 related performance obligation entity is satisfied on day 1 itself. So 892 revenue recognition entity will pass on day 1. But 108 ka discount voucher revenue recognition, can the Reliance or the entity seller recognize today? No. This 108 ka discount voucher revenue entity will book when the customer utilizes the discount voucher in future. When customer purchases the goods in future, that time they will recognize 108 as revenue. Or 30 days, whichever is earlier. Because discount voucher forever it will go, or there is a validity period. How much is that? 30 days. That's the next point. Revenue of discount voucher of 108 rupees will be recognized when the customer purchases the goods in future or time lapses. When will the time get lapsed? 30 days. How 30 days? The question they told. Discount voucher ka validity period is only 30 days. So when customer buys the goods in future or 30 days, whichever comes early. Fine. This is how you need to answer the question. If it comes as a 5 marker, if it comes as 2 marker, you don't have to worry about all the story. But did we understand the working? Everybody. Now, if you want in journal entry, okay, if you have understood, you will tell me the journal entry. Tell me from seller perspective. How much did the seller recover from the customer today? 1000. So entry will be bank account debit 1000. To revenue or sale. Product A is already delivered today only. So 892 ka revenue you can recognize today only. But discount voucher ka 108 revenue you can recognize now or in future. That you will have to treat it as an advance or a contract liability. Okay. Today you cannot recognize revenue. So 108 rupees, whatever amount you have received, you will treat it as an advance. This is related to what? DV. DV as in discount voucher. This 108 from advance account, it will be transferred to revenue account when the customer buys it in future or on the day 30th, whichever comes early. If customer does not buy, then on the day 30th, discount voucher ka validity is over. From advance account, you will transfer it to revenue. This is the accounting part of it. Okay. Journal entry, as I told, suggested answers will not have, and it's not required. Journal entry is required only if the question asks. Otherwise, try to answer as much as possible in words as pointers. That's the best possible way. If it is confusing, if points does not click, then next best resort is probably go for explaining it in journal entry format. That's about this question, sir. If you need a minute, I'll wait. Question looks big, difficult or easy now? Just give me a quick summary of this question. Let's see. What is this now? Here, seller has sold a main product called product A, but they also gave a discount voucher to the customer. So now we are trying to analyze whether a 1 PO or 2 PO. Whether can you treat discount voucher as a separate PO? Yes, provided it gives a material rate. When can you say discount voucher gives a material rate? A selected few customers will get it. So it's not a general discount, it's a special promotion, only few people are getting it. That way, a discount voucher becomes a material rate. Okay, fine. So if discount voucher is a separate PO, then whatever is a transaction price, right, of 1000 we have to allocate it to all the performance obligation. That allocation will be done in what ratio? Standalone selling price ratio. Standalone selling price means if you sell the products individually, what is the value? That is SSP. Product A alone, you will sell it for how much value? 1000. So SSP of main product A is 1000. How do you get SSP of the discount voucher? Very simple. Discount voucher, customer will use it in the future. Take the future purchase value, multiply by the probability of that purchase ka percentage, multiplied by MR discount percentage. Here MR discount percentage is 40. No. In that 40, general discount is how much? 10. So MR discount percentage is only 30. That way you will get the SSP. So in that SSP ratio, 1000 ka transaction price you will allocate. Since product A ka delivery is already happened on day 1, product A related revenue you can book it immediately. But discount voucher related revenue you cannot book it on day 1. On day 1 you will show it as an advance. Discount voucher revenue from advance it will be transferred to revenue account when the customer buys in future or 30 days, whichever comes early. That's all. That's a summary of this question. 8th one you take it as homework, single PO. This is okay. Next, can we do a thing? Can we take a break? There are again, as I said here, there are, in fact, we have multiple small concepts. If you're okay, 1 or 2 more concepts I will do. Or if you feel let's take a break and resume, we can do that as well. How do you want it? You want a break and resume, or another 15 minutes I'll continue and give you a break? How do you want it? Let me know. Your choice. Whichever way you want it. Harish is saying, sir, I'm already bugged, sir. Let's go for a break. No problem. We'll go for a break. No, Harish is not saying that. Harish is being nice only. My extra cholesterol. Then let's quickly do a thing. Let's have 1-2 minutes quick recap of everything we have done and then take a break. Okay, what is the standard name? IND AS 115. Contract from revenue with the revenue from contract with the customer. That's the standard name. Revenue recognition will involve 5 steps. What are those 5 steps? Identifying contract. Second one, identifying the performance obligation. Third one, determining or identifying transaction price. Fourth one, allocation of that transaction price among all the performance obligation. Fifth one, recognize revenue when performance obligation is satisfied. Okay. When can you say a particular agreement can be called as contract for IND AS 115 purpose? For it to be a contract, there should be an agreement between 2 or more parties, right? Contract is basically an agreement between 2 or more parties with enforceable rights and obligation. Now, contract has certain features or definition, which we are remembering it as ARPCC. A for contract, a term should be approved or agreed by all the parties. R for rights and obligations of all the parties you should be able to identify. P for payment terms to be identified. C for contract should have a commercial substance, meaning due to this contract, cash flow should change. Fifth one, consideration collection should be probable, meaning seller should have a reasonable assurance that we will collect the money from our purchaser. Okay. Contract term. Usually contract term is the duration mentioned in the agreement, but sometimes it can be also lesser. For what period you can enforce rights and obligation, that period becomes your contract term. Okay, then we looked at what afterwards. Next, after this, what did we look at? Combining contracts. Sir, if you have entered multiple contracts, can you combine them? Yes, provided you have entered those contracts with a similar customer and nearly at the same customer, nearly at the same time, and any one of the three. One of the three being, it should be a package negotiation, or price of one contract is dependent on the other, or it represents single PO. If it is single PO, you'll obviously combine. Now you understand. Single PO means you cannot treat them as separate. They become one. That's a third condition. Then contract modification. We say contract modification has happened provided there is a scope change or a price change. When can you say scope has changed? Either contract number of units, or either goods ka plus minus has happened, or service ka plus minus has happened, or contract term ka plus minus has happened. Right. So if you want to call it as contract modification, one, that change, that modification should be approved by all the parties in the contract, and the change should be enforceable. Now, whenever there is contract modification, you can look at it from 2 angles. Either you can treat that modification as a separate contract, not as a separate contract. If you want to treat that modification as a separate contract, then a new goods or service should be added, and the increase in contract price should reflect SSP, standalone selling price. Both should be satisfied. If you are treating it as a separate contract, then you apply again all the 5 steps of revenue recognition separately. Existing contract accounting will not be affected. If it is not a separate contract, then we do something called cumulative catch-up accounting. Basically, revenue will be adjusted. If you have booked more revenue, less it. If you have booked less, book more. That's your cumulative catch-up. Second step, identifying PO, performance obligation. Performance obligation means, definition is, it's a promise made in the contract with the customer to transfer a distinct goods or service, or a series of distinct goods or service which are substantially same and have the same transfer pattern. When can you say it's a distinct goods or service? When the customer can benefit from using the asset on its own or with the resources available with the customer, and the goods should not be highly interrelated or interconnected. That is one. Okay. Then what we identified, that's it. No? Discount voucher problem. Even discount voucher can be treated as separate PO provided it offers a material right. That's what we have done so far. Okay, sir. So let's take up the next sort of concept after the break. So let's come back by 8:05. Thank you.